Today we have the short strangle on AMD, trading on a 7 days to expiration with possible up and down adjustment of the strike price. Have fun. So the short strangle strategy is nothing else that you sell a call and a put at the same time with the same expiration, but just different strike prices, as you can see here. So it's a 7 days, and you can see I did this just after the earnings of advanced micro devices. The IVR is still at 24.7, and the implied volatility was around 45, was around 50. So it's a really nice stock to trade. The expiry is August 11, so I trade on the August 3rd by selling a call and a put. You can see here's the volatility, and the delta is 0.09 and 0.08, trying to be delta neutral. That's I get a credit of 0.76, as you can see here. The whole transaction cost me $2 commission plus the fee of the stock market, stock exchange. So let's see what's going on. Here I would just adjust the untested side, as I would show you in the next slides. Here kind of diary every day how I did. So initially again was this one at 0.76, that was done on the August 3rd. Then on August 4th I already did a small adjustment, is because the stock went up. So I did an adjustment that I closed the 104 put and sold the 109 put, because the 104 put was maybe 5 or 6 cents, so I prefer to close that one and come up to 109 and get an initial 0.39. Then the stock on August 8, so it's maybe 4 days later, came down actually, because of stock market fluctuations. So I adjust actually the 126 call, which was really way out of the money, and get a 0.34 by closing the 126 and open the 120. Then on August 9th, just 2 days before expiration, I again adjust the call side from 120 to 115, because again the stock went down. So that, when you can see now, was probably a bit too risky, or let's say too aggressive, because on the August 10 I had to close the 115 call still with a 0.68 debit. So in other words, here maybe that was not so smart to make this adjustment. It's a kind of learning experience. Is maybe the adjustment is a bit too fast. You see I did from 126 to 120 and then from 120 to 115. I would say that it would be enough to do one adjustment on the put side and one adjustment on the call side. And this really doesn't make sense, because you can see I did an adjustment from 120 to 115, and then finally the 115 I had to cover at 0.68, which is actually higher than what I got on 0.5. So this is maybe something we need to learn, not to do too many adjustments. It's like I do every day a kind of adjustment. And August 10th, just prior to 1 day of the expiration, I covered the call, as you can see, and I covered the put, as you can see, and finally I get a profit of 0.9, including all the commission which you pay here every time, $2. I mean, you pay actually initially one time, but when you close the position. So overall it was a nice profit, but I have to say I did too many adjustments. So let's summarize. So the short strangle strategy may be initiated with a delta 5 to 16. I say that is because deltas, I would say, if they are too low, maybe you will not get enough premium on both sides. In AMD, it's quite good. So you can choose a delta like I did with 0.08, a delta of 8 or a delta of 9, which is okay as an initial. Tasty Trade recommends you a kind of delta of 16, because it's a one standard deviation. But it's up to you to do. I mean, it depends really on the stock. Again, watch for stock of IVR, which is definitely higher than 20. because you want to gain most of this extrinsic value. Again, if you sell a call and put out of the money, this is full extrinsic value. Then adjust only the untested side. What means the untested side? This is the side which actually is far out of the money. I mean, this is like when I did in the example before, I did a put untested side is because the stock went up. So you don't check or you don't control, I mean, you don't adjust that one which is very near to the actual price. You always adjust the so-called untested side. But again, be careful to be in small adjustment. It's not that you think, okay, I will adjust and try to be again delta neutral. Because what happened is like in this example, that the stock price may fast and then actually you are already adjusted too much and then you would have to adjust it again the other side. So this is what is my recommendation. Just do it maybe just once a week on the put and once on the call side. What happens to me now, just recently, is as a final solution, you are gonna create a straddle. That means that the stock went down, right? You adjust the call, and at the end you have an adjustment that the call and put have the same strike price. It's because maybe the stock was already below the put price, strike price, so you adjust it. But what is my last recommendation, maybe prior to expiration, one day prior to expiration, that you would say, okay, I have the same strike price for call and put, because again, only one side can be exercised or executed. So that is maybe the only way, like we have seen now this week, that the Nasdaq dropped and you have some stocks which really fell down. So the only thing what you can do is you just adjust the call side till the strike price of the call, and then you wait for expiration, and then you know only one side can be executed, so at least you get the premium of this kind of untested side. Days or 14 days to expiration short strangles is not that everything goes smooth and you enter the transaction and then you will not have to do any adjustment, because it's not that everything goes so smooth. As you can see in any example, if the stock moves up or down, obviously you need to control it and check it. You can maybe do a short strangle with a longer duration of maybe 45 days, but even then, a short strangle is an undefined risk. So in other words, you really need to be and follow it carefully. Okay, that's all for the moment. I hope you have learned something out of it. And anyway, happy Sunday.